Hi, I'm Steve Brice, Global Chief Investment Officer for Standard Chartered. Markets have been volatile over the past 2 months. The S&P 500 index saw a sharp correction, falling nearly 20% from its peak at one point, before recovering most of those losses and turning positive for the year. Trade tensions that were weighing on sentiment have eased considerably. Combined with resilient macro data and solid corporate earnings, these developments have narrowed the range of potential outcomes for risk assets, reducing the likelihood of a sharp drawdown in equities. The US-China temporary truce on trade has reduced the risks of a US economic hard landing and supports a more constructive stance on risk. However, the road ahead remains uncertain and will require careful navigation. Turning to our Signature CIO strategies, it's pleasing to share that our strategies have reached new highs and have delivered strong positive returns. This performance underscores the value of active diversification, not just across asset classes, but also across geographies. Now, the most important question today is whether the equity rebound has legs in the long term, or whether we will see a short-term relapse. To help answer this, we focus on 2 key upcoming event risks. First, trade policy. We expect more trade deals to be concluded, helping sustain the market rally. The 90-day tariff pause is set to expire in early July, and the outcome of those talks will be critical. Second, economic data. While survey-based sentiment indicators have softened, we expect real economic activity to remain relatively resilient. Progress on Trump's deregulation agenda should also offer support. Our base case remains that the US economy is headed for a benign soft landing, with growth slowing below trend. However, a hard landing remains a risk. The latest US sovereign rating downgrade highlights ongoing concerns about US fiscal deficits. Still, we view any significant impact on bond markets as more of a tail risk. Against this backdrop, we're raising global equities to overweight. Given the risks, it's fair to question why we're upgrading equities to an overweight at this point. But in our view, US trade policy risks have eased and market technical indicators have improved. More trade deals and relative resilience in economic activity data and corporate earnings are key to sustaining the rally. Regionally, we upgrade US equities to a small overweight. The Sell America trade appears overdone. However, we will continue to diversify across major regions. We're also overweight China within Asia ex-Japan, given policy stimulus and a softer US dollar. On the other hand, we downgrade gold to a core holding, as we expect a period of consolidation ahead. Elsewhere, we believe high-quality bonds remain attractive at today's elevated yields. In the coming months, various macro themes such as US trade deals, tax cuts and deregulation will shape market direction. US tariffs are likely to cut US growth and lift inflation in the short term. Hence, there is an urgency for the administration to enact tax cuts and deregulation. The complex outlook calls for tempered optimism, and diversification remains crucial to navigate the uncertainties ahead. Thanks for joining me for this monthly Signature CIO strategy update. I'll be back with more updates next month. I look forward to seeing you then.